Hi, in this video, we begin section 1, module 1 of part 2 CMA preparation series, which is about financial statement analysis. It's one of the most exam tested, and from my experience, I could say it is one of the high scoring areas in part 2. This video, we will focus about what is the meaning of financial statement analysis, why management uses financial statement analysis, and what are the main techniques or methods used for financial statement analysis. And from a CMA exam perspective, we'll also discuss some of the questions based on the questions that were asked in the previous CMA exams. Based on my experience, I can share some of the questions and how to answer those questions we'll discuss through this video. When we hear about financial statements, we are basically looking at three major financial statements. One is an income statement that will highlight the operating performance or the financial performance of a business. The balance sheet, which discuss the financial position of a business. And the third one is a cash flow statement, which discuss the movement of cash. And the financial statement, which is prepared by an accountant, is subjected to statement analysis, financial statement analysis, for making decisions. So basically, financial statement analysis talks about evaluating the financial statement and getting key insights about the financial performance and the financial position, so that the interpretation can often give valid insights to the management and other stakeholders to make better decisions. As we often say, numbers by itself being very little. So when we compare it with an industry standards, or with another company's performance, or for the same company we compare the performance of different years, it provides meaningful insights about those numbers. So this session will mainly focus on financial statement analysis and how do companies make use of financial statement analysis for better management decisions, better decision makings. And the financial statement analysis, when I'm talking about, you need to keep in mind that we are talking from a stakeholder perspective, from a management perspective, from an investor perspective, from a lender perspective, and from a shareholder perspective. So we'll be discussing about financial statement analysis from different perspectives. And the most important tools that we make use of financial statement analysis are common size statements or standardized financial statements, vertical financial statements, we often call them, horizontal financial statements, and finally, we'll also discuss about ratio analysis, which evaluate the financial performance of a business. These tools evaluate the financial performance of a business based on the information provided in the financial statement from different angles. For instance, from liquidity, the ability of the company to meet their short-term obligations, leverage, the ability or the effectiveness in using borrowed fund, activity, the efficiency in utilizing their various assets, profitability, ability to generate profit, and finally market ratio, the performance of stock in the market. So we will make use of all these techniques. We'll discuss these techniques. Also, some of the questions that can also give you some insight about how to perform financial statement analysis. Yourself, and to answer the questions, particularly to answer the questions which are part of the examination. So let us discuss about financial statement analysis in detail. Financial statement analysis. So by financial statement analysis, we meant by evaluating financial statements. When I'm talking about financial statement, we talk about income statement, balance sheet, statement of cash flows, and for making decisions. So for example, when we talk about a decision, an investor would like to decide where to invest their funds. It's a decision-making situations. So as such, the financial data, the data in numbers, which is available in financial statements, make little insights if not compared, if not subjected to comparisons with the industry benchmark or similar companies operating in the field, or with the previous performance of the company itself. So there are three major tools we will discuss in this session. One is about vertical analysis. Vertical analysis. We often call them as common size statement. And the second major tool that we will use is horizontal analysis. Third, we can evaluate if we can analyze financial statement using growth analysis, and finally ratio analysis. And in this session, we'll mainly focus on vertical analysis and horizontal analysis. As I said, vertical analysis is also called common size financial statements. And when we talk about common size financial statement, we are basically looking at a common size income statement and common size balance sheet. And this common size financial statement are also called standardized financial statement. Now, when it comes to common size financial statement, as I can show you here, there are financial statements, income statements of main city restaurant provided in the Excel sheet. You can find the income statement is provided for 2023 and 2024. So how do we prepare a vertical financial statement, a common size financial statement? What we do is actually we convert all the elements of income statement as a percentage of sales or the revenue. So what we do in a common size income statement is we convert everything as a percentage of sale. For example, the sale, so we will add a percentage column next to the information, next to the data which is provided, and we calculate the percentage by taking the sale as a percentage of each of the financial statement. We will divide it by the sales, which is here in this case for 2023 it is 450,000, and to calculate a percentage, multiply it by 100. So what we do is actually, as you can see from here, all these numbers are converted in as a percentage of sales. You will find here, when I scroll it down, you can find here that just give me a minute. Okay, so the cost of goods sold remain 50% of the sales, so hence the gross margin becomes the remaining 50%. From the 50% gross margin, operating expenses 33.33% of sales. So the net income, which constitutes $75,000, is actually 16.67% of sales. When we look at 2024, again calculate the percentage in 2024, we can find that, let us do the calculation. So the sale is 500, so we convert everything as a percentage of sales, that is divided by 500,000, and when we convert it into a percentage, we can find that sale always is 100%. Then the cost of goods sold. Now you will find here cost of goods sold is 52% of sales, and the gross margin is 48% of sale, and operating expenses it is 32% of sales, and finally the net income is 16%. If you look at the change from 2023 to 2024, you can find that the cost of goods sold has increased by 2%. The gross margin has, you know, decreased by 2%. There is a decline in operating expenses by 1.33%, and the profitability as a percentage of sale has decreased by 0.67%. So you will find here that though the amount of net income has increased in 2024 from 75,000 to 80,000, there is, as a percentage of sale, there is a decline in profitability. So the company's profitability overall has declined, though in absolute numbers we could see an increase of 5,000. But definitely, if you look at the growth in sales, that net income as a percentage of sales has decreased from 16.67 percentage to 16 percentage. So this is an indication that income as a percentage of sale has decreased, though there is an increase in the absolute dollar amount of net income. Similarly, if you look at a balance sheet, you can find here there is a balance sheet of Main City Restaurant for 2023 and 24. So in order to prepare a common size balance sheet, all financial elements, let me write it here, all financial elements. When I say financial elements, all, for example, assets, current assets, non-current assets, current liabilities, non-current liabilities, shareholders' equity are converted as a percentage of total assets. So here in balance sheet, in order to prepare a common size balance sheet, we divide all the financial elements as a percentage by the total assets of the company to get a percentage. So let me just put a percentage here. As one of the current asset, we divide it by 785,000, which is the total assets of the company. Then what we can do is we can convert all these numbers into percentage. Just click on the percentage. So you will find here the sales, cash is 12.1 percentage of total assets. Similarly, you will also find that property, plant and equipment constitute 57.32 percentage of sales. A similar calculations you can make for the liabilities, and as you know, the total asset is also equal to total liability and equity. Side, you can take all those numbers divided by total liabilities and shareholders equity, which is also same as total assets. Now in 2024, a similar calculation, if you make it, we just put a percentage, then divide all the numbers by the total assets of that particular year, which is 795,000. And as we did, we will convert this into percentage with two decimal points. Okay, so let us see that how it comes out. Okay. So now you can find that the cash as a percentage of current asset has increased, cash as a percentage of total asset has increased from 12.1 percentage to 15.9 percentage. The total property, plant and equipment also increased. And if you look at the change is there is an increase in cash. And if you look at the whole changes in a separate column, you will find that there is a decrease in account receivable that can indicate an effective receivable management policy. Inventory also declined from 30.57 percentage to 25.16 percentage. There is an increase in investment in property, plant and equipment from 57 percentage to 59 percentage. You will find that there is a 4.55 percentage increase in the long-term debt of the company. The company has borrowed more money Also, the current liability has increased. So, increase in asset is mainly driven by the flow of funds from creditors and the operating liabilities. You will also see that there is a decrease in retained earning from 28.3 percentage 03 percentage to 20.94 percentage. That is a decrease of 7.08, which is of course a negative signal for the shareholders, because their holdings in the company has reduced by 7.5 percentage. Book value of their holdings in the company has reduced by 7.5 percentage. So looking at this profile, you can see the leverage of the company has increased, and the shareholders' equity has reduced. There is an increase in total assets of the company, driven mainly by the increase in the liabilities or the debts of the company. So this is an insight that we can generate from looking at the balance sheet and converting it into a common size balance sheet. Now let us look at two questions in order to better understand the concepts and the calculation that we just discussed. A company performed a vertical balance sheet analysis and reported that the current asset is 35% of total assets, non-current asset is 65% of total assets, current liabilities 45% of total liabilities and equity, long-term debt of 15% and equity of 40%. The company plans to fund a new project, a short-term new project using internal sources. Based on the analysis, which conclusion should management make? Based on the current analysis, which is out of the following four options, which is the right conclusion that you can make? In order to do that one, let us look at the ratios which is given. Current asset is 35% of total asset, and current liabilities are 45% of total liabilities. So current assets are financed by current liabilities, you could say. Current assets are 35%. The remaining 10% of current liabilities are used to fund non-current assets. You can see that from the analysis given here. The short-term assets are financed by short-term liabilities, and long-term assets are, it is ideal to be financed by long-term liabilities and equity. But here you will find that the company has funded non-current asset also from the current liabilities, because if you look at it, 45% of total assets are financed by current liabilities, out of which 35% is current asset, and you can also see 10% will be the non-current assets. So if you look at the different options, you see that option 2, option B, the company relies heavily, currently the company relies heavily on short-term liabilities to fund their assets, which has an impact on the liquidity risk, or which increase the liquidity risk. It claims that the company's performance has improved in the current year, emphasizing that net income exceeded the previous years. Looking at the financial statement, we need to prepare a common size statement, and we need to look at which conclusion is most appropriate. So let us do one thing, let us calculate prior year's percentage, current year percentages. So prior year percentage as a percentage of sale, we have calculated, we will convert into percentages, and the current year 18,000 divided by 18,000. Now this also we need to convert. While making this analysis, always make sure that you use two decimals in order to convert it. Now you can find here that the management claims that profitability has increased, but in effect, if you look at it, net income as a percentage of sales has decreased really. Though absolute term there is an increase in net income by $120, $20,000. But on an average terms, in the current year, the profitability has decreased by 6 percentage from 15 percentage to 9 percentage. So which of the following claim is most appropriate? You can see that option C, profitability relative to sale declined despite higher net income. So the management claim that the company's performance has improved just by looking at the absolute numbers in increase in dollar amount is not an indicator of an operating efficiency, because as in percentage term, net income as a percentage of sales has decreased from 15 percentage to 9 percentage. That means operating inefficiency, the profitability. You can see option number C is the right answer for that one. And in the first question we said option B, because it shows that the long-term asset, also a part of the long-term asset, is also funded by the short-term liabilities, which increase liquidity risk. Means when a company need to repay, liquidity risk arises when a company is unable to repay their obligations on time. I would like all of you to make to practice few more questions. Prepare common size income statement and common size balance sheet as part of vertical financial statement analysis, which is also called standardized financial statements. Comparing the performance of a company with the previous year performance, we can see that whether operating performance or financial position of the company has improved or not. We can also compare the performance of one company with another company. The companies having different, sales or different asset in absolute terms. By converting them into as a percentage of sales or as a percentage of total asset, we can get better insight on the financial position and financial performance of the company. We can also see by looking into the financial statements, we can also verify whether the management claim on an improved performance based on absolute terms is really valid. We can also see which department, which area, for instance, that when the cost of goods sold as a percentage of sales has increased, you can see that the department that are involved in that particular process, one is a production department, one is a purchase department, because when we calculate cost of goods sold, we calculate the cost of purchases and the direct expenses, which are related to the purchase department and the production department. So you can see that whether any flaws in those department has resulted in an increase as a percentage of sales. If the operating expenses has increased, similarly, you can see that one. This can be either administration related or it can be a selling expenses. So by looking into these statements, by analyzing their performance using common size statement, you can attribute the results to particular department, and in case if changes are required, management can intervene with specific focus on those departments which have which has resulted in that performance indicators. So as I said, continue practicing more number of questions. In case if you have any question and you would like me to clarify it for you, then feel free to put those questions in the comment option so that I can prepare or I can assist you in completing that one. Thank you so much for your involvement. And in the next session, we'll focus on the horizontal financial statements, then the growth analysis, and also finally, we will also focus on the ratio analysis in detail. Thank you for listening.